Okay, welcome to Lots of Pips Trainings. This is Jared Passy, and this section of our overview, we're going to be talking about the psychology and planning of your trading and how your mindset and planning can impact your trading. All right. So, trading psychology. There's three basic legs on the trading the Forex stool. Okay, you need three legs to be able to stand up. You can't stand a stool up on two legs. So the three legs, one of them is technical analysis, right? Or your analysis. What clues do you have to tell why the market's going to move up and down, where it's going to go? You can't just sit there and guess or use your psychic friend to tell you where the market's going to go. So that's one of them, technical analysis. The next one is money management. If you don't have good money management, but you have good technical analysis, you're still going to lose money. Okay, and the third one is the psychology. The mindset of a trader is crucial to long-term success. The disciplined mindset is crucial to long-term success. This is something you're going to have to practice. Most people, I'm not saying everybody, most people don't have the right mindset. Okay, we're going to talk about a little bit about greed and fear. Okay, greed makes you do things in your trading that can hurt you. Okay, jumping into trades because you don't want to miss out, that's greed. Staying in trades too long, that's greed. Okay, fear is the same way. Fear gets you out of a trade that's just fluctuating, but still going in the direction you were planning on it, but you got afraid that you're up 50 pips and it drops back down to you're only up 20 pips, so you end up closing it, even though your plan was to go to 200 pips. You can't be afraid of the little fluctuations in the market. You need to have solid clues or reasons why that trade would change directions for you to need to get out. Okay, trading in the zone. This is a mindset that you maintain. We've got a whole section on trading in the zone that we go into. It's like runners get in the zone. Trading in the zone involves, following your rules, being confident, things like that help you stay in the zone. When you start to lose things, you start trading by fear, you start trading by revenge, that's out of the zone, and you're destined to donate your money to some broker or the market. And then how to view success. You can't view success in trading one trade at a time, because you'll be on a roller coaster ride that's going to get you sick. Okay, you have to view success based on pips instead of dollars. You view success based on percentages, and you view it on longer time frames. I view my success on percentage per month, not dollars per trade or dollars per day. That's the worst day. The worst thing is dollars per trade. Okay, if you say, "Oh, I lost, $40 on this trade," or "Oh, I made, $1,000," or "I lost $1,000 on this trade," or 50 cents or whatever, if that's what you're focusing on and that's how you view success, then you're going to be on a psychologically, a mindset, an emotional roller coaster while you're trading. Okay, so you need to back up and take the big picture on success. It's all about probabilities. So if you have a 70% success rate on a certain strategy, you need to understand that I can lose 3 out of 10, and that's part of my plan. That's part of what happens, and it's okay. And if 2 of them happen in a row, you don't need to freak out and throw your plan out the window, which I've seen a lot of times. Okay, we're trading on probabilities. Now, probabilities of, like I just said, if you have been demo trading a certain strategy for the last month, and you're placing a couple trades a day or a few trades a week, and you figure out that strategy has a 60% probability of success when it does A, B, C, and D, and you can get in and capture twice as many pips when you win than when you lose, then hey, you're set. You just need to be able to maintain the mindset that you're set. Okay, because as long as you're getting at least 50% of your wins, and your wins are larger than your losses, you look at that at the end of the month, you're going to be profitable. I guarantee it. Okay, there's still going to be fluctuations because 60 is never a solid number, but that's where we're at there. Okay, trading plans. Successful traders follow well-designed trading plans with discipline. We've got trading plans, we've got trading routines, we've got trading laws, we've got things that we do to make sure that we are disciplined, that we are not just flying from the seat of our pants traders, because they don't do as well. Okay, your plans should include your laws, your routine, entry and exit rules. Okay, what do you need to see to get in? What do you need to see, or what needs to be happening, or why are you getting out? Okay, I know a lot of traders, excuse me, I know a lot of traders that just focus on when to get in, and then they have no real rules or reason to get out. They just want to get as many pips as they can. Well, that doesn't work out so well for you. Okay, so make sure you have entry and exit rules. Make sure your routine is pretty good on what analysis, and you've got things figured out so you don't get surprises and you don't miss things. You know, I've missed many trades because I wasn't doing my routine. Okay, I wasn't doing my analysis each morning that I do to determine what might be developing, what chart patterns might be forming, okay, what trend lines might be getting broken through. Okay, and then part of your plan is follow-up and reflection, your journaling. Okay, you have to track your trades, right? If you're a small company doing marketing, you have to track your marketing. You have to figure out which marketing works and which marketing doesn't work. If you don't, they all just go into the same jumble of marketing, and you never realize that half of them aren't doing anything that you keep spending money on, and half of them are, 20% are the real money makers. And you could have gotten rid of 4 or 5 things and put all your money into the 20% and made quite a bit more money and lost less. So you have to use your journaling for your follow-up and reflection. You have to study your journals and say, okay, which pairs do I do better on? What times a day do I do better on? What can I get rid of? Which pairs should I stop trading because I just can't seem to get it figured out? Your follow-up and reflection helps you create your trading laws. Okay, which strategies work, which strategies don't work, how can I tweak certain strategies? Can I make the stop loss a little bit bigger? Should I make the stop loss a little bit smaller because it doesn't seem to get to my stop loss? I'm giving up too much when I'm wrong, things like that. And then goals, set some goals as far as how that goes. And goals go well with any endeavor you're doing. Okay. All right, tracking results. We talked about that. Keep a journal, crucial success, new and existing strategies, fine tune. Oh, I got through all this earlier on the last slide. Recognize your correct mindset issues. I had one lady that as soon as she started losing, she'd lose several in a row. And one of the rules that we had to give her was, hey, if I lose 2 trades in a row, I have to take a break. I have to wait till tomorrow to trade. And it changed her profitability each month because she was getting into revenge trading, right? And she didn't recognize that without this journal, the trading journal that she had to use, that I had her use to be able to track this. That was when she saw a flaw in her system, or that we saw a flaw in her system, and she's able to fix that and added a trading law that fixed the problem. Okay, trading without a journal is like flying an airplane in the blind. You don't know where the mountains are. You're just keep on flying, and you might survive quite a while, but one of these times you're going to hit a big hill, and it's going to change your whole account. So, anyway, journaling is really important. That's my soapbox on journaling. That's it's really important. All right, testing and practice. You've got to be able to keep testing, keep practicing. Don't find a strategy and say, this is it. I'm going to go to my deathbed with this strategy, and it's never going to change. It's great, because the market does change. Okay, the market changes. It goes from a trending market to a channeling market for a year or things like that. So we're always tweaking our systems, our strategies. I've had some strategies that have worked just awesome for 2 years straight, and then the market shifts, and I've got to shift and change my strategies. You want, fine-tuned systems. You can backtest strategies with certain charting software. Get your chart time. Practice. Okay, what I call chart time is like on a basketball court, people that have more court time are better. It's not that they sat there and studied basketball more. It's you just need to be on the court. You need to tune your body and your mind to be able to do that. Same thing with this. You can't study everything and then become a good trader. You've got to have the time in the saddle, whether on a demo account or a very small live account. That's a whole discussion in itself. But chart time is crucial. And I don't see people start making progress in their trading until they've really put in some chart time, looking at charts, getting used to all that. Market awareness is also good. You need to pay attention and stay up to snuff on the market and where things are going and what's affecting the markets and things like that. So you don't have to be an economist. Just kind of keep your fingers on the pulse of the market. Are we generally doing good? Are we generally doing bad? Are we recession? Are we whatever? What's nice is the Forex market is a recession-proof market, and all we have to do is trade on the fluctuations in exchange rates. You can't have it. It won't die, per se. So that's testing and practice. We put it all together. We've got an example of Trader Bob. Okay, let's take a look at Trader Bob. He's putting it all together. Okay, he follows his routine each morning to determine good trading conditions. Okay, he's using skills and tools that he has to analyze the charts, looking for trades that follow his rules. Okay, his Fibonacci's, his checks out the news announcements. He does things to find trades that meet his rules. Okay, he finds a trade that meets his criteria. He uses his money management to determine how much to trade and how much to control his risk, or how to control his risk. So where to put his stop loss, how much to trade, where to put a take profit, whether to use a trailing stop loss, what's there. Okay, he follows his trading laws while he's in the trade to avoid reacting emotionally. This is the trigger here that messes you up. When you react emotionally to your trading, greed and fear will take over and mess up your trade. So he follows his trading laws while in the trade to avoid reacting emotionally. Okay, he exits the trade based on analysis or his preset targets. Okay, so he determines that, that move's about done. It's showing me the clues and signs that it's done. I should get out right now with this profit. Or he has a preset target and says, I want my take profit up here, my stop loss down here, and I'm going to go and leave it alone and find out what happens. Based on my probabilities, I should be a winner and move on. He tracks each trade in a journal, looking for patterns that help him tweak his plan to be more profitable. Okay, you have to keep track so that you can continue to tweak and recognize changes in the market, to improve your strategies and your styles, and be a better trader. And he also continues to trade based on probabilities. So he looks at the big picture. He doesn't trade, doesn't look at success based on one trade at a time. He looks at it based on probabilities, on his strategies, and his mindset. So that's Bob. He's got it together. So these are some of the things you need to get together to be a good trader. Okay, congratulations. You've just finished the basic training and overview part of the Forex market. Hopefully you're in a better position to determine how you want to proceed. Some people jump into trading Forex without a clear picture of what they're getting into, and I hope this has helped you get into. This is not at all a complete training to where this is everything you need to know. That's another program, but hopefully this will get you enough to be dangerous, enough to decide whether to start. Here's my soapbox speech. Trading Forex is not for everybody. There's substantial risk. Don't go risk your rent money or your food money to trade Forex to try to get more rent money or food money. That's not the right mindset to be in. There's too much pressure to be right. Trading Forex is only for investing with expendable income, money that you don't have to live on, that you will not be devastated if you lose. Okay, so if that's $200 to start out with, then so be it. But I don't want anybody coming in thinking that they're going to get rich in 3 months and they'll be able to pay all their bills, because that's not going to happen. Okay, maybe 1 in a million. It's the mindset has to be right, and if you have a lot of pressure on you to get it working, then you will have an extra hard time. So keep that in mind, and good job. If you want to continue on, you can watch the MetaTrader videos that I have below here in this section, and we'll see you out there. Good luck, and may the pips be ever in your favor. All right, see ya.